Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome back.
Hi, Julieta. Good to
Garth,
be back.
good to have you. We spoke about short positions in the show last week. Today, we're going to talk about a couple of the long positions that you took on the top 40, and this is against the option structure that you put in place. So maybe let's kick off with how that small long trade that you took on the top 40 panned out.
Yes, that's right. I spoke about this, I think, 2 or 3 weeks ago on the show, and at the time, I said I was worried if the market continued higher, then it puts our option structure in danger. So just to sort of, I suppose, sketch the landscape, as it were, that chart that's up on the screen now is a chart of the top 40, and this whole situation on the right-hand side is the options payoff profile. And what it is really, it's a put spread option structure, but it's funded with the sale of a short call option, and what was an out-the-money call at that time, not so out-the-money anymore. And the payoff really looks like this. Below 47,000, we earn a small premium on this structure. It's about 1,100 Rand. Then below 43,000, we start to make money on that option structure. However, above 47,000, that structure loses us money if the market moves higher. And it loses us money at a rate of 10 Rand per point on the top 40. Now, that became problematic for me in the middle of March, when you can see the market actually popped up above 47,000 over there. And at the time, I said, well, if that is the case, if we're going to see the market moving higher, then I don't want to be totally exposed, because effectively you're kind of naked short from there on. And if the market continues to rally, you continue to lose money. The more the market rises. So what I did at that stage in the middle of March was I looked at the technical setup on the shorter time frames. I saw the market looked as if it was breaking above a small little rising wedge pattern, and I thought, this looks like it's going above 47,000. So let me put some sort of a hedge in place to protect us. If the market should go higher, then I want to at least have a long position on there to kind of offset any losses that we would incur on that option structure. So I went long 2 contracts of the IG market top 40 product, which is a 2 Rand per point product. So effectively, I went long of 4 Rand per point at 46,634. So I was kind of a little bit ahead of the game in terms of the market breaking out above 47,000. Of course, being hedged with 4 Rand per point long doesn't offset the 10 Rand per point that I would lose as the market goes above 47,000. But I said at this stage that I didn't want to be 100% long against my options, if you know what I mean. So I know it gets very complicated, but anyway,
but essentially, it was a small hedge against a hedge.
It was a small hedge against the market moving higher, because if the market moves higher, then that option structure starts to lose us money. And obviously, my whole thesis around that option structure when we put it on in January was that the market looked as if it was very likely to break to the downside. And I still suspect that might happen, but it's probably only going to be much later this year, if it happens at all. So that structure now kind of worries me a little bit. If we look at the hourly chart of the top 40 future here, this actually spells it out a little bit more clearly, and you can see what I've done subsequently with that hedge. So that was the tiny little falling wedge pattern that I spoke about, where I saw the market breaking to the upside, and I figured then it was going to go and push out through 47,000. So I used that wedge pattern as an indication that I needed to get long. And I did. I got long at, as I said, 46,634. Now, the market did rally. You can see it rallied about another 1,500 points from then. Okay, so we were well in the money with this hedged part of the structure, if you like. But then we had this head and shoulders pattern that began to form in sort of the 3rd week of March. And it then broke to the downside. And I then said to myself, well, okay, it looks like we've got a short-term little topping pattern in place here. With the break below the neckline of that head and shoulders pattern, I may as well now exit that hedge, because now it looks as if the market's coming back down again. So I sold it out at 47,240. And what that meant was that I actually made a bit of a profit there. Unintentionally, I suppose, because it really was just a hedge to give us a little bit of protection against the market moving higher. But we made 2,424 Rand after costs were taken into consideration on that transaction. And
I suppose you didn't want to run it because, in fact, you would have been stopped out, considering what the market's done subsequently.
Yes, well, that's it. I mean, as long as the market was, as long as I was in the money with this hedged portion, I would have been comfortable to hold it. But if the price had gone below my entry point, then I would start to lose money on that, which I didn't want to be in that situation. And yes, you're right. If you look at how the market's traded subsequently, it's gone lower than our entry point. So exiting it then actually was, in retrospect, was a good move.
Okay, Garth, so, all right, so that's the option structure, and you still have it in place.
Yeah.
And so hopefully, the market actually turns down because
well, this
give you
is
peace
it.
of mind.
Just to go back to this slide now that you can see, this is how the situation stacks for us now. We've effectively still got this option structure on as I originally put it on without the hedge now. And if the market stays weak, we are okay. If the market goes below 43,000 by June, which is pretty much there where I've plotted this structure, actually, if you look at it in terms of the timeline on the graph. Below 43,000, we'll be in the money. I'm not sure whether that's going to happen now or not. But anyway, as long as it's below 47,000, I'm happy I can sleep at night. If the market starts to break higher than that, then it does begin to concern me.
Yeah, and presumably you would have to maybe do a similar thing.
I might need to hedge it out again. And this is the frustrating thing. I mean, we've got 2.5 months still to run until the futures close out, and it's there and thereabouts at the danger zone. So I need to manage this thing carefully without getting too caught up in the volatility around it as well.
Okay, so that's the option structure, which is maybe causing you more grief than you would have expected it to, which is the irony of the situation. Garth, what about just a pure long trade that you took in life healthcare? You must be quite frustrated by that chart.
Yeah, goodness me, this is frustrating. You can see the chart of it over here. And what I identified was that we have this rising, or it's an ascending triangle pattern, actually. With the rising bottoms here, with the flat tops through 36 Rand per share. And the thesis here is that when you see a pattern like this, typically what it's telling you is that there are buyers at the lower levels, and they're active because they're taking that price higher. And every time the share price falls back, the buyers step in at a higher level to take up some stock. And the sellers are still there sitting at 36 Rand, but the sellers are not strong enough to push the price to make lower lows. So if you had to say to yourself, who's the stronger force here, buyers or sellers, you would say that the buyers are actually slightly stronger. And when that pattern eventually resolves itself, the likelihood is it probably will resolve itself to the upside. And that would probably result in a fairly powerful break to the upside. And that's what I've been looking for. But as you can see, for 6 weeks, and well, longer than that, but particularly for the last 6 weeks, it's been bumping up at 36 Rand. It's had a few false starts as well, where it's tried to break out through 36 and then it's come back down. And that's frustrating, because you expect that once it gets through that level, once it breaks out through 36 Rand, then it should actually get going. It just seems that there's still plenty of selling pressure at that 36 Rand level. We are in it from 35 Rand 80. We're long of 1,225 CFDs there. And I'm looking for a move up here to about 39 or 40 Rand, that sort of area, with a stop loss at 32 Rand 80, which is quite far out the way down here. We kind of more or less at the money or slightly underwater with it at the moment. It's not doing anything for us. So it is frustrating. And I'm going to give it a little bit more time to see whether it can work for us. But if not, maybe it needs one just to execute a time stop loss and then find something else to do.
I mean, having said that, though, the position that you've taken in it relative to the portfolio is small. And even though this is a trading show, I mean, can you just sit with it, as long as it's not losing any money, and maybe it's a chart that takes a bit of a longer time period to actually work out, then what's wrong with sitting holding it?
There's nothing wrong, really. The only downside is that you do incur finance cost with your CFDs if you hold these things. But remember, your financing cost on CFDs is not exorbitant. I mean, it's cheaper than the funding on a home loan, for example. So to hold this small position is really not costing us a great deal in terms of financing. So yes, you're right. I could sit tight with it and just leave it and let it work, and hopefully at some point it does eventually resolve to the upside.
Yeah. Okay. So life healthcare remains in the portfolio for now.
Yes.
It's had a stay of execution.
Yeah.
Garth, I know you want to talk a little bit bigger picture, because clearly we're taking our cue from what's happening to US markets, and also, I suppose, considerations around US interest rates. So you've got the S&P 500 up there.
Yes, this is S&P 500. We look at this most weeks on the show, and it's interesting. Now, I've been saying for a while that I thought it was going up to 2080. We've spoken about a double bottom that formed here in January and February, and that double bottom actually projected up to the 2080 level. Now the S&P 500 has got there, and it's traded to that level, and seems to be looking as if it might be running out of steam now at this point. What's interesting to note is this negative divergence that is evident on the stochastic over here. And what negative divergence indicates is that your upside momentum seems to be waning. In other words, it just doesn't seem to have the same amount of upside momentum as what it has had previously. And very often when you see that negative divergence, it does preempt a short-term pullback or a short-term change in trend. It happened back here in October last year, and you can't unfortunately see it so clearly because there's that writing in the way, but there was negative divergence over there. As the market was making higher highs, so the stochastic makes lower highs, and that is a warning that the momentum is running out. And then you can see what happened thereafter. We saw a pullback and months of sideways choppy action thereafter.
And I suppose what would help the US markets are company earnings, but are they actually supportive of the markets ahead of us?
Well, this is the thing. So if you look at the chart that's up now, this shows a huge discrepancy now, where it effectively looks at the S&P 500 from the beginning of this year. This is so 1st of January to date. The dotted line there, that one is the S&P 500. And you can see that the market's been climbing and climbing. But what's been happening to earnings estimates at the same time? They've been declining. So you've got this huge gap that's opened up here now, where the market has moved higher, yet the earnings expectations have moved lower. So somewhere there's a disconnect here, and either the market needs to probably come down to get more in line with the earnings estimates, or alternatively, this next round of first quarter earnings need to come out really strong and surprise to the upside, which is seeming quite a remote thing at this stage in time. So there's this big disconnect, and as we now enter the first quarter earnings season for the S&P 500, it's going to be very interesting to monitor those earnings and see how things play out.
Now, I mean, you sent me a couple of notes. You talk about blackout periods. What do you mean by that?
Yeah, so what that means is that there's been a massive amount of share buybacks by companies in the US particularly. And what that is where companies are sitting on these vast piles of cash, but they can't really find anything useful to do with that money. They're not paying it out as dividends, and they can't really find any new business avenues to spend that money on, to reinvest it. So what they do is they end up actually going into the market and buying back the shares of their own company. And by doing that, they reduce the number of shares in issue, but then that also serves to enhance the earnings per share number. So it is earnings enhancing to do that. But a blackout period is when companies are due to report their earnings, between their quarter end and their publication of their earnings, that is what's referred to as a blackout period. We kind of call it a closed period here in South Africa. And companies cannot buy back their shares during that time. So what we found is that these share buybacks have been very, very prominent in pushing up the market. And when these blackout periods come, it does tend to often lead to a bit of a softening in the S&P 500.
And what about the VIX? I know you want to quickly touch on that before we wind up the show. What's been happening there? Because it seems to have gone quiet.
Well, VIX is interesting. I spoke about this in January this year and said that VIX was actually quite elevated at that stage. But what's happened subsequently is VIX has come back down. VIX, by the way, is the volatility index on the Chicago Board Options Exchange, and it's a measure of implied volatility on the S&P 500 options. High volatility indicates sort of market panic, fear, uncertainty. Low volatility indicates a market that's fairly complacent. Now, we come back to this low volatility area now. The VIX is sitting below 15 in terms of its reading, which is very complacent. But what's quite interesting to note is that on your RSI and on your stochastic, look at that, you've got them both making higher lows, whilst the VIX itself is making a lower low. So what that is positive divergence. And that is also an early warning that we might be about to see a pickup in volatility in the near term.
And that's when you want to buy the VIX, is when periods of low volatility.
Yes.
And guys, just before we have a look at the portfolio, I know you also wanted to mention the dollar index.
Yeah, very quickly, let's have a look at the US dollar index. Now here it is. The US dollar index is a measure of the US dollar against the basket of currencies that it trades against. Predominantly dollar euro is the biggest constituent of this index. It's been trading in this downward channel for the last 5 months or so. It's right now down at the bottom of this channel. And notice again, there's positive divergence on the stochastic and on the RSI, which indicates an early warning that we might be about to see a period of dollar strengthening from here. And a stronger dollar would be a headwind for equity markets. A weaker dollar, vice versa, is a tailwind for equity markets. So if you kind of stack everything together that I've spoken about, we've got the S&P at resistance, we've got blackout period coming. We've got VIX looking like it's about to turn up. US dollar index looking like it might strengthen. All of this stuff, to me, points to caution in the near term.
Okay, big orange light there. 10 seconds to wrap up,
Okay.
Garth.
All right, so our portfolio is down 0.5% for the year to date still. It's improved from the last time I was here, but those are the positions that we've got open at the moment. And then last thing quickly, I've got courses coming up. I've scheduled courses in Johannesburg and Cape Town. You can see the dates there in the beginning of May. So anybody that would like to attend any of those, please email me, garth@traderscorner.co.za, and I'll send you all the info.
Okay, great. Garth, thanks as always for joining us. Garth McKenzie's founder and editor of Traders Corner.